Welcome to the Deep Dive. We take complex information, like today's focus, Organogram Global's Q2 Fiscal 2025 earnings call, and we break it down for you.
Exactly. And this quarter is pretty significant.
Yeah, definitely pivotal. It's, the first real look we're getting at their financials after the rebrand to Organogram Global and after getting that Motif acquisition fully integrated.
That's right. So we're going to see how those big strategic moves are starting to, translate into the numbers.
And spoiler alert, the numbers are pretty big this time around. We'll unpack what it all means.
You should be interesting. It really feels like a company in transformation.
Absolutely. Okay, so let's start with the snapshot, the big results. What really jumped out, I think, for both of us was the revenue.
Oh, yeah. Record-breaking quarter on that front.
They actually surpassed $100 million in gross sales. First time ever.
Which is what, a 79% increase compared to last year? That's huge.
79%. I mean, you hear numbers like that, you almost think tech boom, not cannabis right now.
Right. It's impressive top-line growth. And that strength, it carries through. Net revenue was also way up. 74% year over year, came in at $65.6 million.
Okay, so big sales growth. But what about profitability? Because that's where the story often gets, more complicated.
True. But there's good news there, too. Adjusted gross margin improved. It hit 33%, which is up from 31% the previous year.
And that wasn't just random, right? You mentioned Motif earlier.
Exactly. The company specifically pointed to the Motif acquisition and also strong international sales as the key drivers for that margin improvement.
Makes sense. And that flows down to EBITDA.
It does. Adjusted EBITDA came in at $4.9 million, which is, a really significant improvement from the negative $1 million they posted in the same period last year.
Wow. Okay. So going from negative territory to almost $5 million positive on adjusted EBITDA, that's a serious turnaround. What's the main factor there?
A lot of it ties back to Motif again. Integrating that business brought in higher margin products, plus those cost efficiencies they were aiming for. It shows the core operations are starting to really generate positive cash flow.
Okay. Core operations looking healthier. But then there's this huge net income number, $42.5 million. That seems, almost too good to be true compared to the adjusted EBITDA.
Yeah, that $42.5 million number definitely catches the eye. But you need to look closer.
Okay, what's the catch?
Well, the vast majority of that, about $35 million, came from a non-cash item. It's a change in the fair value of derivative liabilities.
Ah, okay. So accounting adjustments, not cash from selling more product.
Precisely. It's related to long-term financial agreements, mainly with British American Tobacco, things like their top-up rights and preferred shares. So it boosts the net income line, but it's not operational cash.
Got it. So focus on the operational improvement, the adjusted EBITDA swing. What about actual cash flow from operations?
That also improved significantly before working capital changes.
Yeah.
Still a slight use of cash, $1.6 million used. But the key thing is they ended the quarter in a really strong position.
How strong?
$83.4 million in cash on the balance sheet. And crucially, almost no debt. That gives them a lot of flexibility, a lot of firepower.
Okay, solid cash position, minimal debt. That's a good foundation. Let's dig deeper into those financials, specifically the margin outlook. Adjusted gross margin was 33% up year over year, but you said it was flat compared to last quarter.
Yeah, sequentially flat. But they mentioned they actually exited the month of March at over 39%.
Oh, interesting. So the trend within the quarter was positive. What are they guiding for going forward?
They expect it to sort of stabilize around 35% for this fiscal year, fiscal 2025, but they have a longer-term target, aiming for 40% in the second half of fiscal 2026.
40%? That's ambitious. How do they plan to get there?
A big piece of it is those Motif integration synergies we talked about. They're expecting $5 million this year, but then it jumps significantly. They're now anticipating $15 million in annual synergies next year.
$15 million. Didn't they previously say $10 million?
They did. So they've actually increased their synergy target. It's a pretty bullish sign on the integration benefits.
Definitely. And what about operating expenses, G&A, selling costs?
This was impressive, too. General and administrative costs, G&A, stayed flat at $14.9 million. Flat, even though they added the entire Motif business.
Wow. That shows some serious cost control during the integration.
Absolutely. Selling costs did go up a bit to $7.5 million, mostly due to higher trade investments. But overall, SG&A as a percentage of net revenue dropped dramatically. It went from 54% last year down to 34% this quarter.
54 down to 34%. That's huge operational leverage kicking in.
Exactly. It means as revenue grows, more of that money should fall to the bottom line. They're already at $6.3 million in adjusted EBITDA for the first half of the year, and Q3 and Q4 are usually seasonally stronger. So they're definitely on track to beat last year's adjusted EBITDA.
Okay, the financial picture looks increasingly solid. Let's talk strategy. How are they actually achieving this in the market? The Motif integration seems key.
It is. Operationally, they've consolidated all their commercial THC extraction now at the Elmer facility.
And that's running full tilt.
Apparently 204/7 on its hydrocarbon line. Yeah. And they're investing more there too. About $800,000 in new capital.
What's that for?
To more than double their distillate production capacity, aiming for 2,900 kilograms a year. And also double hydrocarbon isolate production to 1,400 kilograms.
So more volume, better cost control.
Right. And it opens up bigger opportunities for B2B sales, selling those extracts in bulk to other companies.
Makes sense. Now let's look at Canada. The overall market grew, 4% year over year? How's Organog doing there?
They're doing very well. They claim the #1 spot market share-wise for licensed producers in vapes. That's a big category.
What's their share?
21.7% in vapes. And they're also #1 in pre-rolls.
Okay, vapes and pre-rolls, together that's like half the market, right?
Pretty much, yeah. So having leadership there is critical. But they're dominant across the board. Flower, vapes, pre-rolls, those make up about 85% of the total market.
So they're covering the big bases.
They are. But what's interesting is their strategy within those categories. They're defending share in the broader segments, but also really focusing on leadership in more concentrated, higher value niches.
Like what?
Like flavor forward, milled flower, where they have over 40% share, or hash, where they hold about 20%, and gummies, over 17% share. These are areas where they can innovate and potentially command better prices.
Okay, smart strategy. Defend the core, dominate the niches. What about outside Canada? International sales.
That's where the growth was really explosive, up 177% year over year.
Wow. To what level?
Reached $6.1 million in the quarter. A lot of that is deepening ties with existing customers, especially in Germany, with the Sanity Group.
Germany's a big opportunity, right? Still early days there for medical cannabis.
Huge potential. Patient registration is still really low, like 0.5% compared to maybe 2 or 3% in more mature medical markets. So lots of room to grow. They also supply the UK and Australia.
And Australia, they're launching branded products soon.
Yeah, they expect to launch their box brand vapes in Australia later this calendar year. That's a significant step, moving from just supplying bulk to selling their own brands internationally.
And there was something about EU GMP certification. Why is that important?
Yes. European Good Manufacturing Practice. It's basically a pharmaceutical quality standard. Getting that certification, which they expect soon, is a really big deal.
Why is that?
It allows them to ship directly into European medical markets, cutting out intermediaries. That means better margins and faster fulfillment. It really opens up those higher value EU markets.
So higher margins internationally. Are they shifting focus away from Canada then?
It's a balancing act. Management seems quite aware of this. Yes, international offers better margins because there's no Canadian excise tax, but they're also emphasizing maintaining leadership in Canada. In fact, they mentioned the Canadian market is tightening supply-wise, and they've actually been able to increase some prices domestically, which also helps margins.
Interesting. Okay, now for the really new frontier. The U.S., the collective project acquisition got them into hemp-derived THC beverages. That market sounds like it's on fire.
It really is. Already over $1 billion in 2024, and some projections have it hitting over $4 billion by 2028. Massive growth potential.
And Organog's products, collective project, they're already out there.
Yep, distributed in 10 U.S. states. They're in major retailers like Total Wine already. And they're investing $1.2 million to bring some of the beverage manufacturing in-house up in their Winnipeg facility.
What's the tech angle there? I heard something about nanoemulsion.
Exactly. Fast nanoemulsion technology. It basically means the THC particles are incredibly tiny, so your body absorbs them much faster.
So quicker onset.
Quicker onset, more predictable duration, and a cleaner offset or come down. That's a major selling point in beverages, where people are looking for a more controlled experience compared to, say, edibles.
Makes sense. So what's the plan in the U.S. right now? Just get the drinks out there?
Pretty much. The focus now is driving trial, building awareness. They're running summer support programs. It's about building that brand and category presence. They've apparently won some awards for taste and quality already, which helps.
Okay, lots of positive momentum. Motif integration, Canadian leadership, international surge, U.S. beverage entry. But growth like this always comes with challenges. What are the potential, speed bumps here?
That's a good point. I think the biggest challenge is just execution. They have so many major initiatives happening at once. Integrating Motif, expanding internationally, launching in the US, plus a massive capacity build-out we haven't even talked about yet.
Right.
Doing all of that flawlessly requires really tight operational control and a deep bench. Spreading themselves too thin is always a risk with this much ambition.
Do they have the resources? You mentioned their cash position earlier.
They do. That $83 million in cash helps. Plus, they still have $58 million left in that Jupiter strategic investment pool they set up. That's after putting money into companies like Open Book Extracts and Sanity Group. So they have capital if other M&A opportunities pop up too.
Okay, good point on the resources. Let's talk about that capacity expansion you mentioned. They need more product if they're growing this fast.
Exactly. They're putting $16 million into capital projects over the next 18 months, specifically to enhance capacity.
16 million. Where's that going?
About $9 million is going into upgrading the lights in their main grow facility in Monton to LEDs. They estimate that alone will boost flower production by about 7,000 kilograms a year. Should be done around June.
Okay, 7,000 kilos more flour. What's the rest?
Another $7 million project involves using their warehouse space in London, Ontario, more effectively. That frees up space back in Monton for 9 entirely new grow rooms.
9 new rooms. How much capacity is that?
Another 7,000 kilograms annually. So total, they're adding about 14,000 kilograms of annual flower capacity. That second phase should start coming online early in fiscal 2026.
14,000 kilos. That's a huge increase. And it helps margins too, right? Spreading costs.
Absolutely. More volume helps absorb those fixed costs, which is key for margin expansion.
And they're also doing something innovative with seeds, not just cloning.
Yeah, that's pretty interesting. They're really pushing large-scale production using seeds, specifically F1 stabilized seeds. About 22% of their harvest in Q2 came from seeds.
Why seeds? What's the advantage?
Consistency and cost. The goal is more repeatable flower characteristics, batch after batch, and potentially lower production costs compared to traditional cloning methods. It's faster, potentially more efficient. In a maturing market, that kind of operational edge could be a big deal.
Okay, so lots going on. Let's try to summarize. What are the key things we should be watching for from Organog in the next few quarters? What are their main priorities?
They laid out 4 main ones. First, keep accelerating that international growth, more exports, get those branded products launched in the US and Australia, and crucially, get that EU GMP certification finalized.
Okay, international first. What's second?
Keep gaining share in Canada. Focus on innovation that resonates with consumers there.
Third.
Margins and cash flow. Keep driving gross margins up through those Motif synergies, leveraging their increased scale, and maintaining that tight cost control. They want consistent, positive cash flow.
Makes sense.
And fourth,
Advocacy. Pushing for regulatory changes in Canada, things like common sense rules, reforming the excise tax structure, and developing a national strategy to support cannabis exports.
right, the regulatory environment is always a factor. Let's quickly revisit cash flow. You mentioned Q2 was negative, but intentionally so?
That's right. Key point. The negative cash flow was largely driven by spending cash on purpose. About $6 million went to pay for the collective project acquisition.
And they also strategically built up inventory. They spent cash to have more product on hand because they expect stronger sales in Q3 and Q4, which are seasonally better. So it was an investment for future growth.
So the expectation is positive cash flow soon.
Yes. They explicitly said they expect to be cash flow positive for the full fiscal year, starting in Q3. And again, that strong balance sheet, the $83 million cash, negligible debt, gives them the runway to make these investments.
Okay, so pulling it all together for you, the listener, Organog's strategy, it seems like this interesting mix, right? They're defending their turf in Canada, the established market.
While at the same time, really aggressively going after these high growth areas, international, medical, U.S. hemp beverages, which maybe have higher barriers to entry. It's quite a balancing act.
Yeah, and what strikes me is how the investments line up with the strategy. The big spending on capacity, on extraction upgrades, plus bumping up those Motif synergy targets, it all points towards a clear plan for better margins and efficiency.
Definitely. And having that cash cushion and almost no debt, it just gives them the power to fund it all, including having that $58 million still sitting in the Jupiter investment pool for future moves.
And the innovation piece, the seed production, the fast-acting beverage tech, that feels like they're playing the long game, looking for sustainable advantages.
I think so too. It shows they're thinking beyond just surviving the current market and more about how to actually win and be profitable long-term in a CPG-like environment.
And catching it back, like you said earlier, balancing those high-margin international sales with keeping their leadership in Canada, even taking price increases there, that shows a pretty sophisticated understanding of the different market dynamics.
Yeah, it's not a simple growth at all cost approach. It feels more nuanced.
All right. It is time for our segment, This Is Not Financial Advice, where we put on our speculation hats and throw out an idea that's maybe a little out there, but, plausible.
Okay, let's do it. Here's my thought for a potential long play. Call it the triple threat leverage.
Triple threat leverage. Okay, I'm intrigued.
So forget looking for just one reason Organog might do well. Consider they're hitting three massive levers pretty much all at once.
Okay, lay them out.
Lever one, that huge 14,000 kilo annual capacity boost in flower, plus doubling extraction at Elmer. That scale is going to seriously spread out their fixed costs. Lever two, realizing those higher Motif synergies now pegged at $15 million a year. That flows right into cost of goods, pushing up gross margins.
Okay, capacity and synergies. What's lever three?
Lever three, the aggressive push into the U.S. hemp THC beverage market. That market's already $1 billion and set to quadruple fast. It's a whole new, potentially massive revenue stream.
Right. So three big growth drivers firing simultaneously.
Exactly. Any one of those would be a pretty big catalyst for most companies. But doing all three together, that could create this compounding effect on profitability that maybe the market, maybe analysts are underestimating right now.
So the outrageous but plausible part is
The bet is that this combination, the efficiencies, the synergies, the new market entry, doesn't just get them to their 40% gross margin target, but gets them there much faster than people expect. And if that happens...
the stock gets re-rated.
Potentially, yeah. The market might suddenly stop seeing them as just another Canadian LP and start pricing them like a dominant multinational cannabis and consumer packaged goods player. That could mean a significant valuation shift. Outrageous. Maybe. Plausible. Given the simultaneous execution. I think so.
Interesting angle. So wrapping up, Organogram Global's Q2 fiscal 2025 results. They really paint a picture of a company hitting its stride, executing on those key priorities. Motif, collector project, international expansion.
Yeah, the focus on innovation like the seeds and beverage tech, plus the operational improvements and cost control, it seems like they're setting themselves up for potentially strong growth and better profitability ahead.
Now remember, everything we've discussed here is for educational purposes only. It should absolutely not be taken as financial advice.
Please consult with a qualified financial professional before making any investment decisions. Do your own research.
Definitely do your own research and reach your own conclusions.
Yeah.
So thinking about everything we just covered, what's the one thing, maybe a surprising fact or insight about Organog that's going to stick with you?